Starting to watch. Give me a second. I'm just going to make sure that we are live streaming properly on my account, Gareth's accounts. So give me a second here. Looks like we are good to go. Appreciate everybody that watches these lead lag live shows. I used to do this via Spaces, but now I'm doing them face to face. And I like having good faces on shows, which is why I have the handsome Gareth to be the guest for the day here. Please, folks, do me a favor as we're live. If you have any questions or you want to kind of engage with us as we're live, you can type questions in the chat. For those that are watching on YouTube, I'll be able to see that on Restream. If you're watching this on Twitter/X, either on my account or on Gareth's, I'll check the responses there and see if I can bring in. So just make this interactive as we're live. And with all that said, my name is Michael Guyad, publisher of the Lead Lag Report, as well as overall crazy guy on social media at Lead Lag Report. Joining me for the rough hour is Mr. Gareth Soloway, who's a little bit crazy himself, but I think in a better way than I am. Gareth, I know you've done the media round, and I know a lot of people obviously know you and follow you, but just introduce yourself or maybe reintroduce yourself to the audience. Who are you? What's your background? And why in the world are you as good as you are?
So I'm my name Gareth Soloway, like you mentioned. Been a trader for about 25 years. In fact, it might even be a little bit more than that now. So I've been through the ringer, and I think that's really what has made me into the trader I am today. And you know, it's when you keep getting burned doing different things, you eventually learn. Some learn faster than others. I think I took a lot of time to learn myself, but basically you just learn that certain things work and certain things don't, and you start to understand that the markets are a complex organism of human nature and psychology. And honestly, that's been the biggest breakthrough that I've ever had in trading, is understanding that chart analysis is really just understanding human nature, greed and fear. And that's what it comes down to. You throw in a little Fed printing of money and it makes out the markets. So that's me in a nutshell.
All right. So you used the word the market. And I put a post up a little bit earlier today saying, well, now we're down to one stock as the market.
That is the truth.
We went from Mag 7 to just one.
Yep.
And apparently there can be only one.
Highlander, baby.
Yeah, it is 100%, right? Now, okay, so which is actually an interesting analogy, right? Because I think the only way that Highlander could die is you have to chop off the head.
That's right.
So, okay, let's go with that analogy.
Now the question is Nvidia the head or is the Federal Reserve the head?
Okay, so that's a good. Okay, right. It's the two J's, Jerome or Jensen. Okay, so help me out here, because you know I've been very wrong on Nvidia, but I've been saying, yeah. And by the way, I think a lot of people have been wrong, because if they were right, they would have been levered at that initial spike up a year ago and held onto instead of trying to trade it. But never mind that. There is this saying in markets that the generals fall to the soldiers, right? The narrower that breadth gets, at some point, the weight of that concentration in that select number of stocks falls to everything else, which is sending a very clear message in terms of weakness. Mm-hmm. Which, by the way, was always my thesis for why I thought Nvidia would be in trouble. I'm not going to use the word I kept on saying on Twitter/X, and obviously I've been wrong. But the reality is there's a lot of weakness still beneath the surface. What's going to take off the head? What's it going to take to break Nvidia?
Oh my goodness, you know, and that's the big question. So number one, we have Nvidia, which today I'm looking over here. It's adding 21.6 points to the S&P 500. The S&P 500's up 5.6 points on the day. So basically, the S&P would be down 15 points today if it wasn't for Nvidia, which is pretty astounding in and of itself. The closest competitor in terms of adding points to Nvidia is Apple, which is adding 2 points, 2.33 points to the S&P. So, I mean, at this point, this is a one stock market, and we would be negative today if it wasn't for Nvidia. Now, for it to end, you know, there's got to be a point where you get max bulls on board. Because the story's not going to die yet, right? I mean, the AI story is going to continue. I think it's going to be a scenario where it's death by 1,000 cuts on Nvidia, where over the weekend we heard, I think China's putting $65 billion to work in building out their own set of chips, AI chips, which will eventually permeate the whole entire system, right? So if we remember what China did with solar panels, they produced them so cheaply, and then they flooded the U.S. markets and the world with cheap solar panels that it crushed all the other solar providers, and essentially we had to put tariffs on it. I guess that would be one of the ways that you would see this kind of party end for Nvidia. I also just think that, you know, anytime you have a product with margins in the 70 to 80% level, essentially capitalism takes care of itself, and what you're going to have is every other company, AMD, Intel, I mean, you name it, Broadcom, producing or starting to produce AI chips, which eventually crush the margins, right? And so I think that's really the end game here. Is I look at Tesla in 2021 and how hot of a stock it was, and then I look at Tesla now, the margins getting compressed. We have all of these other things, and my guess is looking 2 years down the line, that's Nvidia in the future. But again, that's a long way off.
It's funny you mentioned that, because the analogy everyone throws for Nvidia, including myself, is it's Cisco from 99, 2000. But I hear more and more people making the argument this is more like Tesla of 2020. It might just be a hybrid of the two. Or maybe this time it's different, in which case Nvidia is going to be the entire stock market, which at this point, if it continues like this, is going to be the case. I want to get your thoughts on the narrative that's out there that this utility strength is because of the sudden realization that AI is going to use a shit ton of electricity. Now, I am very skeptical of this. I have myself argued that if AI is real, that three things need to happen. Utilities do have to outperform. Small caps have to outperform because they benefit from the productivity enhancement of AI, right? From margin perspective. And bond yields have to collapse because AI is inherently disinflationary. I don't care how much debt the US government puts out there, it's disinflationary, deflationary, as technology always is. So now suddenly the narrative is that, well, utilities are strong because of all the electricity demand coming down the pipeline. The problem, and I want to get your response to this, the problem that I have with that narrative is that doesn't explain why consumer staples are outperforming consumer discretionary since February. Doesn't explain what looks to be some strength building in healthcare, defensive sector. What's going on? What's happening with this utility strength? Is it this AI narrative, or is there some defensive posturing taking place?
So it's probably, like we were talking about with Cisco and Tesla, it's probably a combination. So investors, especially in this market, have this willingness to chase anything that is hot. And if whatever's the hot story, it was GameStop for a little while, then it was AMC, then it was FFIE. We saw money chasing those. And so I think there's this beginning portion where institutional money starts to recognize the problems in the system and starts to rotate their capital. And then the retail investor and the investing public has to say, well, we don't want to believe that the economy is really maybe going towards recession. We're not hearing that from the Federal Reserve. We're not hearing that from our government officials. And the stock market's at all-time highs. So you know what? It's got to be the AI narrative, the electricity narrative. Heck, last week, First Solar had this monster run of like 40% because some analysts said, hey, this is actually an AI play because guess what? They need lots of electricity. And First Solar's had this incredible run. And so I think there's a combination of the two, but I do think that the ultimate end game is that these are running because we are seeing this rotation of smart money, the big money, the institutional money towards the utilities for the safety side of things, like we've seen in past recessionary periods. And I just like to point this out is that, number one, transports just broke a Head and Shoulders neckline. So Head and Shoulders, for those of you that don't know, is a bearish pattern. The transports never made a new all-time high from 2021. And now you have a breakdown in their charts. Number two, we have many economic indicators, and I'd love to discuss more about this with you, but you have things, for instance, rising personal debt, like things that are staples of pre-recessionary periods are starting to pop up left and right. Rising personal debt, inverted yield curve, consumer confidence down 3 months in a row, slowdown in the housing market, increased layoffs in certain industries, except the government's been hiring a ton of people to kind of make up for that. And plus, we've seen a lot of people taking multiple part-time jobs because they can't find a full-time job. So all of these things to me are signals that we should be concerned about, but the stock market is a lagging indicator in that way, that the investing public is chasing return right now. And it's not until it's kind of too late that we start to see the stock market roll over.
All right. So actually, I'm glad you mentioned the transports, because that also confirms the idea that it's defensive posturing, because the transport should be around. Maybe just give a little bit of an educational lesson on Dow Theory. Now, I will preface this by saying, when it comes to transports, I always joke that Dow Theory should not be a theory. It's been over 100 years. It should either be proven or not, right? So you always have to take this stuff, I think, with a grain of salt. But why are transports important from a technical perspective?
Yeah, so the essence of it is that when you have when you have the Dow transports moving up, number one, it's basically the staple of the U.S. economy, right? It's how many things are being shipped back and forth. It's the demand for shipping, which ultimately cycles through to the consumer. So when you have transportation stocks that are lagging and starting to roll over, there's a reason there. And we've heard about, actually, we haven't. I shouldn't say that. The mainstream media is not necessarily reporting on the transportation companies that are laying off people, but there are a decent amount of layoffs going on in the transports. And it basically just essentially tells you that the Dow theory is telling us that when you don't have the transportation index, essentially moving in that direction, in the upside, there's problems in the underlying markets. And I think that's what you're leading to with the transportation stocks breaking down as well. So you might be able to explain it better than I, but essentially the transports, for a strong economy, you need the transports going up, essentially.
Yeah, I mean, it shows you basically, to your point, economic activity, it's about transporting goods, right? So you'd expect that that should be a beneficiary if things are strong. I will ask a question from the audience, and I'm wondering about this too, Gareth. What happened to the man bun? It looks like you got a haircut. Come on now.
Yeah, so basically it was summer, and in Florida here it gets really, really hot. And I was getting annoyed with having to take care of it and all that stuff. So I just said, you know what, let's get rid of it. Let's start the summer on a good note, a kind of a beachy note. And that's really the essence of it. It wasn't anything more than that. It was just kind of getting tired of it, and it was getting hot here.
You're not like Samson, where you cut the hair and you get less strong, just to be clear. I mean, your skill is not changed.
Thank you so much. I appreciate that. But if you want to show my chart, let me show the head and shoulders on this if we pop this up, because I think people find this interesting. Is that so? This is the head and shoulders I was referring to on the IYT, the transportation ETF, and we can see here a shoulder, head, and then shoulder. And then what we could see here recently is the breakdown right here below the neckline. This is called the neckline, where you connect kind of what I consider the armpit to the armpit. And essentially what you can do is you can do what's called a measured move here to calculate the target. You take the highest point of the head, you drop a plumb line straight down, and then you take that $7.50 level from the break point and you bring it down. And interestingly enough, it basically brings us into this level down here. So essentially that's what I was talking about there. And then if we zoom out, here's the 2020, here's the previous high, right? So here's your high right up here in 2021. And we can see we did a double top, but now we've rolled over versus the S&P, the NASDAQ have just ripped through those 2021 highs and have gone much, much higher. So it's just an interesting chart to pay attention to, a chart that not a lot of people are talking about, but I do think it's worth, people to realize what's going on here with the transports.
Okay, now you mentioned transports never hit the 2021 highs.
Right.
Now, this is something I've been harping for the last year. And it's now gotten to the point where people think that I'm a perma bear because I keep saying this, which is just completely nonsense. Anybody that's tracked my work knows that that's not the case. But I keep making this point that you look at the Russell 3000 index. Right now, 70% of stocks, literally, in the Russell 3000 are trading below their 2021 highs. Right now, 70%. That includes small caps and mid caps. Obviously skewed more towards small caps. We'll talk about that. 58% of the Russell 3000 actually never even overtook the 2021 high once. In other words, that 70% number I told you was because you broke the 2021 highs on the upside and then retraced back. So my point is that there is a lot of weakness, and it seems like you can argue the bears have kind of been right, not in the market cap weighted headline averages, but when you look at a lot of the constituents beneath the market surface, it's been kind of a terrible 3 years.
Yeah. Yeah, and I think what's so important here to understand is, and this goes to the Mag 6. I call them, Mag 6 now because Tesla's kind of fallen apart. But in reality, you're right. The biggest players are lifting the indices higher, and there's so many stocks. I mean, you could go through a bucket list of these names. Starbucks and Expedia, which is travel, right? Starbucks, which is consumers. You got Disney. You got WDAY today, which is Workday. I mean, all of these are now moving towards almost 52-week lows. Yet the indices continue to move up. And you're right. There's so many names out there that have really been crushed on the back of whether it's lowering guidance and the consumer starting to break. And I think this is really important is that, we always talk about, and everyone always hears that the consumer is the backbone of the economy. Well, the consumer now has $1.1 trillion in credit card debt. There's phantom debt that's $500 billion, which is buy now, pay later. We have auto loans. We have mortgages. We have rents that are just continuing to kind of be horrendous. And you have this disparity where you still have decent consumer spending because 62% of the US has stock holdings, and the stock market keeps making new all-time highs, which makes people think, wait, I'm richer than I was last month. I can keep spending. But what happens when that doesn't occur? And the bigger question, I throw this back to you, Michael, is what are your thoughts on inflation? Because I don't see how the Fed, first of all, can cut rates with all-time highs, with markets at all-time highs. And number two is, unless the markets fall, how is inflation coming down? Because the consumer is still generally, at least the wealthier consumers, are still spending like crazy because the markets keep going up.
Okay, so last year I was very public in saying I thought the Fed over-tightened last year.
Mm-hmm.
That changed in November when Powell effectively liquefied the system by getting the market to think 6 cuts were coming. Because the effect of that was credit spreads were starting to widen towards the end of October when I was like peak bearish. And then they completely collapsed, meaning the differential between high quality and junk debt really just narrowed and narrowed and narrowed.
Yeah.
And that's a way of looking at liquidity, right? If credit spreads are tight, ample liquidity, because the market's basically saying there's no default risk by highly levered debt issuers. As spreads widen, that means default risk is rising. That's liquidity coming out. That's a reevaluation of low volatility likely turning to high volatility. I'm with you. I don't see how the Fed can possibly cut rates with credit spreads this tight because, yes, they will unequivocally reaccelerate inflation. They need, I would argue, they need credit spreads to widen. They need there to be actual stress in the system, which I have been very wrong on in my timing. I don't think anybody had on their bingo cards. You go through all this turmoil in the bond market, and it's purely interest rate driven, not credit risk driven. Right. I tell you, Gareth, I'm always blown away. People don't understand the difference between rates and credit risk. Totally different dynamics. So, yeah, I'm with you. Now, having said that, can they still cut rates? Yes. I think they would cut rates because there's concern about something coming.
Right.
I keep going back to this point. I still think Japan is the risk.
Okay. I agree with you on that. I think that is something that is not talked about enough. And look at that dollar yen chart. It is an incredible chart. And I thought that what was so interesting here, and I'll bring up the USD JPY and we can kind of take a look at it here. But one of the things we have to recognize is that the US has shown big concern about the intervention potentially of the Japanese central bank. And by the way, there's no doubt they did intervene right here. I mean, this was the way this fell as suddenly as it did. That was an intervention. But the U.S. government has come out and said, hey, please don't intervene. We're kind of warning Japan not to intervene because one of the ways that Japan would have to intervene is by selling U.S. debt, where they're the biggest holder, right, of U.S. debt. And what does that do to interest rates? Does that then take power away from the Federal Reserve to control interest rates and potentially spike interest rates if Japan starts to unload U.S. debt as the biggest holder there? And so I do think this is a huge risk. And notice how, look at this. I love the chart here. Here was your pivot high, right to here, right to here. When they intervened, we went right back to that. That's called the scene of the crime. It was the breakout, and we retraced to the breakout. And then look, we're starting to creep higher again. And my guess is within a couple weeks, we're back at these highs. And then the question is, does Japan have to intervene again? And what are the repercussions of that? So I agree. This is something that is huge. And remember, debt to GDP in Japan, 250+% debt to GDP is a big gorilla in the room there.
I have to tell you, I don't understand how people don't understand what exactly is happening when it comes to Japan. I mean, I keep going back to there's only one of two scenarios now. Right? Either they let it keep going, meaning they don't intervene again, in which case the yen shorts are going to press like hell. Right? I mean, there's record shorting going on as far as speculative positioning on yen futures. But then on top of that, if they do intervene, it wasn't enough last time, so they have to probably panic and do something even more aggressive, which then sparks potentially a squeeze, right, in the yen. And that's where the whole reverse carry trade dynamic comes out. Now, it could be the case that that's why treasuries are are meandering a bit here, because there's concern that intervention by Japan means they have to buy yen, sell dollars. Well, if they have to do that by selling treasuries first to get dollars, then that's going to put pressure on our government bonds here in the U.S.
Yeah. Yeah, no, it's definitely just one of many things. And I think one of the things that blown me away is how low the VIX has gotten, Michael, and in terms of being down at the 12 or sub 12 level with these potential risks out there. And to me, it's usually hedge funds are the ones that are protecting themselves with these buying, let's say, calls on the VIX or protecting themselves by owning the VIX. And it doesn't seem like it's happening at this point. There's so much focus on just being long the market, even in spite of the Middle East and China, Taiwan issues, Ukraine and Russia issues. And then you go to even domestic things here with whether or not the economy will slip into recession. What about the elections? Will there be issues with the elections in a few months? And then again, the dollar yen issue as well. I mean, and again, I'm probably missing about 10 different risk factors, but the markets are definitely just kind of saying we don't care right now. And that's what makes that, when that happens, that makes me scared. Like that makes me on high alert.
Comment from, I think it's your YouTube channel. Why is Michael filming on a 2010 Motorola Razr? Apparently some of you are complaining about the blurriness. I'm not sure why it's showing us.
You're so much better now, by the way. You were a little blurry, but it's gotten much better.
It's, yeah, I mean, I'm trying to be a little bit more accentuated given the fasting and how I look and feel nowadays. I wanted to be blurry, a year ago when I was a lot heavier. Okay, there's another comment, and I want to get your thoughts on this because I know you.
By the way, let me just point this out. I love how a majority of the comments are on my man bun and your blurriness versus the quality of content that we are speaking about.
Hey, man,
does that speak to the bigger issues within the United States and the world right now?
You know what it is that most of these comments are from AI that are being run on Nvidia GPUs. So you can tell that this is the large language models are clearly just messing with us. Okay, so you mentioned you've been a trader for a long time. I've been a portfolio manager, for a long time. We get things right, we get things wrong.
100%.
My approach is rules-based. Yours is more discretionary. And I see some comments from, people that just say, oh, here's a couple of guys who have been wrong on many, many things. And I always go back to this point that everyone is wrong and everyone's right in this business. It's about the magnitude of being right relative to the magnitude of being wrong that matters. There is this impression out there that the best traders are the ones that are right often. It's completely not true. You have to be right with size. You can be right 20% of the time as long as you hit home runs. That's how you end up outperforming. So let's talk about where the fat pitches are. Right? What are some of the big next trades in your view that you're eyeing that you think might be coming? I think it's clearly volatility, and again, I go back to it's credit spreads widening. Because to your point, when you talk about low volatility, that's tied to credit spreads. That's been the whole thing that's been missing in this cycle. That's why I've suffered in my own strategies using treasuries as the risk-off option, because you have not had the flight to safety sequence because spreads have just been so tight. But what are some of the real layup trades coming up, you think?
Well, first of all, I would love to say that there's a layup trade, but in my history, I can tell you that every time you think it's a layup trade, it's usually not. It's just the nature of the market always keeping you humble, and I've gotten plenty of calls wrong, and I'll get plenty more in the future, and we all will. But I do think also it's like you said, it's important to recognize, again, it's the long game. It's not the short game, it's the long game. But I think for me, at least in terms of some of these layup trades, I love the idea. And again, one of the big trades that I called out over about 6 months ago was starting to go long China. China started to have this beautiful move up. And one of my favorites is the K-Web here. And in fact, I don't know if you can flip over to my chart, but this was what I had isolated down on my chart here. There we go. And you can see that we had this beautiful channel and it came off of this V bottom here. And then anytime you spend this much time digesting the move up here, which was a reversal. So see how fast it went up. And then all this time where you're staying inside of that move, that's very, very bullish. And look at how we got above that line, consolidated, and then had the big break up. So I continue to think the pullback here in China, granted, are there risks there? And please understand, folks, anytime I'm investing small amounts because you want to stay diversified. So I just want to just point that out. I think that's super, super important because you will go broke if you go all in on any one position. I've found that out many times in my early career. But the key here is, again, the pullbacks. You buy pullbacks on this trade, in my opinion. I think assuming that China doesn't do anything crazy, then China is a great place to go. I also love the EWZ, which is Brazil. And what you'll see is, and look at this chart, man, amazing trend line going. This trend line goes back. If I go to my weekly chart, we're going back to 2010. And look at the breakout that's occurred and the consolidation. And to me, this, again, is a great setup for a big move up. And what you'll notice is a lot of my favorite trades are moving away from U.S.-centric type investments because I think the U.S. is way overdone historically. Michael, I know you're equally as old as I am. I think you are, at least. And basically, there was a day 10, 15, 20 years ago where a large cap, mega cap play back then, the PE ratio was in the, 10? 10 was reasonable, maybe 12. Here we are with Apple, Nvidia, and all these others. 30 is the new 10, I guess, or the new 20. I don't think that lasts forever. And I think money has just been drawn into the US, but eventually will go elsewhere for other economies that are going to do better, that maybe have a better situation going on.
By the way, I'm with you on China. I've noted that that strength seems to be confirmed by copper. Right, China is the largest importer of copper, so there is some consistency there. I saw a comment from somebody on the fat pitch point, Red Pill Finance, saying fat pitch equals palladium. Now, I've written about palladium also.
Actually, that's one of my favorite plays, and I'm long palladium right now too. Actually, so sorry to interrupt.
Let's talk about that, because I think there's a lot of, I think justifiably so, attention on gold, right? And which I keep on saying is sending a warning. I still think that it's sending a warning. But let's talk about palladium, because there's gold, there's silver, and then nobody really talks about palladium, which is why it probably works.
Yeah. So, and that's been one of my favorites right now. I have my chart up of palladium here. And basically what we've seen is, gold and silver are the flashy ones. Those are the ones that everyone knows about, but we forget about these other ones. And if for me, let me explain my thesis for being invested. So I have a large stash of gold. I hold gold because for me, when I look at the U.S. debt, nearing 35 trillion, and I look at the Fed balance sheet, 7.5 trillion, and every crisis it doubles, if not triples, right? And then they reduce it by 10%, and they say, oh, well, we've reduced it by 10%, let's back off now, because God forbid we go back to the pre-levels and we would kill the economy and kill the markets. But essentially, there's no real way out of this. I mean, again, you can either raise taxes and crush the economy. That would be one way to pay down the debt. But show me a politician that's going to be reelected in 4 years that's going to raise taxes and actually do that. It's just not going to happen. And so you're basically going to have to print our way out of this. And the end game is precious metals are precious. They're traded in dollars. They're scarce, just like Bitcoin, in all fairness. And that really puts me in a position of saying, well, what's rare? Well, guess what? Palladium and platinum are actually, I think, about 10 plus times rarer than gold and much rarer than silver. And so if I'm looking for something that it has rare aspects to it, palladium, the chart on palladium is like coiling here for a breakout, in my opinion. I mean, look at this chart, this consolidation down here, and it's trying to break out above this trend line. So I'm a big fan of palladium. I'm right there with you, Michael.
Any thoughts on the Ethereum ETF and sort of this next hopeful surge when it comes to the crypto space? I've noted this before, and again, folks, I'm not an anti-Bitcoin guy. I'm just anti-stupid narratives. I really like store of value.
That, by the way,
no, it's like the store of value and inflation. It's been a phenomenal investment. I never once said it's not. I've never once argued Bitcoin has not been a phenomenal investment, but the way that people characterize this stuff is just definitionally doesn't make sense. But it seems like every time you get excitement around Bitcoin at 70K, it immediately drops. 70K, it immediately drops. And now there seems to be this narrative out there that, okay, now the Ethereum ETF, and that's going to have a halo effect that maybe benefits the Bitcoin side of things. Where are we when it comes to crypto? I know you've been yourself, maybe skeptical. I saw some comments saying, oh, you were bearish on Bitcoin at an earlier price. Okay, when things are that volatile, it can hit that price again very quickly. Right.
So I was bearish at 69,000. Said it would go to 20. When it got to 20, I said if the stock market collapses, it could go as low as 10. The stock market obviously didn't collapse. I think we all can agree we're at new all-time highs. I do like Bitcoin itself because of its scarcity aspect. Just like I like gold, silver, palladium, platinum. I like that aspect. I do think there are issues that people don't want to talk about with Bitcoin. For instance, are you really, remember the ledger is a ledger, right? I mean, every so it's really, there was a narrative for a while that was like, oh, well, Bitcoin is, you get to keep your independence, you get to do what you want. Well, that's not really true now, right? So it loses that. Now, the big narrative is, oh, well, the institutions are adopting it. Oh my God, if you told people 5 years ago that was going to be the narrative, they would have freaked out. We don't want institutions to adopt it. Oh my God, we want this to be the people's thing. But that's the driving narrative that people are going with, which is fine. I'm for being in plays when they go up and being in plays when they go down on the short side. But to me, right now, the Bitcoin chart, just purely looking at the chart, it's actually not a bad chart. You do have consolidation. I don't know if you could throw up my chart here, but we do have consolidation above a channel. There was a downsloping channel. So you basically had the bull run from 40,000 to 70,000 or so, right up here, right? That's 74. And then we've gone into this consolidation area. We broke above here and we're staying above it. So that would keep me on a bullish bias. And I think one of the things, and Michael, I think you're in agreement with me on this, is that what people have to understand is that you can have short-term biases being I'm plenty of times I'll go short Bitcoin, but I might love it on the long term. Right. And same thing with gold. I'm still a mid to long term bull on gold, but I'm actually short gold right now. I'll flip that around as soon as I make some money to the downside. Right. So I think that's also important for people to remember. I think people take highlights from what you say in one particular situation. They kind of take out all the caveats that you put in there and just say, oh, well, he said this. And then it goes the other way. But you have to look at the big picture and look at multiple things, like what's the time frame. And I think that's very important.
I don't know if you've been watching the biotech stocks at all, but part of the reason why small caps have lagged, if you're going to stay away from the zombie company argument, could be because there's a lot of these very small biotech companies that are also holding back the indices, the Russell 2000 type indices, and they've been kind of left for dead because the alternative argument would be, all the money's gone into Eli Lilly and the GLP-1 craze and everything else, sort of grabbing all the mind share as far as the healthcare space goes. Biotech's been a terrible performer since 2021. And I know there's a lot of granularity in terms of individual stocks, but any thoughts on if biotech could be a surprise winner? I happen to think that it will probably be a momentum leader as healthcare itself becomes a beneficiary of money coming out of tech. But biotech looks really interesting to me.
Yeah. So I agree with you on that. I think, the craze over the GLPs ones, that's kind of been overplayed a little bit at this point. If we go to the charts and we look at the Eli Lilly chart, check this out. It's actually a really interesting channel here. So we have Eli Lilly that was above this line. It finally broke back in, and now the line has become resistance. And so if Eli Lilly breaks below this level, which is around 765, it actually should have a pretty big corrective move. And I do think that, again, as popular as these are, the same thing that's going to happen to Nvidia is going to happen to these guys, is that everyone out there is going to produce them. And before you know it, you're going to be able to get it at your local pharmacy for $5, copay or whatever it is, very minimal cost on these GLP-1s. So I think that these are probably long past, and I think money is going to rotate out of these names. And one of the ones that I like, at least, is Biogen. BIIB is the symbol on this. And if we look at this chart, it's a pretty big company, decent sized company, and it came down right down here, had a big bounce, and is now retracing. And it's interesting just to look at this pattern here. It's almost like a little inverse head and shoulders if it curls back up. But I think this would be an interesting one. I used to play the really micro cap ones, trying to hit a home run, and then I would always lose on them. So I really focus on the larger cap ones, but I do think the Biogen chart's an interesting chart down here. And there are other ones, but I always look at one of the other ones, Pfizer's another really interesting one here. We had a breakout. So this was in this big downtrend. Then look at this little bit of a choppiness. Here we broke out and now we're retracing. And honestly, anything around 27 is a buy on Pfizer. And I think you start to play the rotation out of the Eli Lilly's back into these names. I think even, what was the other one? Was it BMY, Bristol Myers? Bristol Myers is another one that's gotten crushed. And these are the ones where I would probably look to, especially as a safety hedge for the overall market, because they probably won't go down that much in a bear market.
Yeah, and actually, I think that's sort of the main point about the defensive behavior, right? The utility, staple, and healthcare tend to move the same. Another comment, which I want to bring up, which I think goes to your earlier point about the comments. Somebody here saying, thank God that the man bun is gone. And I do want to ask you this. Was this like Coming to America with Eddie Murphy, where they just cut it off like that and he charged you $50 because of inflation? Is that
exactly?
Is that what happened?
Yeah. It's so funny too. I'm looking at some of these comments and it cracks me up. It's like I just said about the time frames and being short gold, and then someone's like, "Oh, you're gonna get wrecked because the gold's gonna go so." And I'm like, dude, I still have a massive pile of gold that I'm still holding on the long side. It's a short-term trade. Like, please understand the time frames. And it's just, oh man, I know you get frustrated with it too, Michael.
Oh no, it's
like, oh dude.
Well, no, and actually, I turned my X account private because I'm just done with the insanity of people that don't. I think what happens is you still have a lot of people that are learning.
Yes.
They have some success,
which is why we do what we do, right?
Right, and there's nothing wrong with that. But the thing about being a learner when you have early success is you think that the pros, and you can debate whether we're pros, but have skin in the game, which I think qualifies us as pros, that we don't know what we're saying. And then they say things like, oh, you've been bearish on Nvidia all last year. How's your short doing? And it's like, okay, first of all, I'm the first one, unlike you, to say don't short. I know it's very hard to do systematically. Some people like you could be very good at it tactically, but even if you're short, you might have a short thesis on the short term. Doesn't mean you're going to be holding it for years.
No.
So it's like the mentality.
Markets go up over the long term. Shorts are shorter term trading opportunities.
Yeah, and you can be bullish and bearish at the same time, depending upon time frame. I don't understand why people don't recognize that time. It's more than just what's your position. Over what time frame are you taking on that position?
Right. And it's the thought process that when you say one thing that 10 years from now, you must feel the same way. And a real trader isn't like that. A real investor isn't like that. There are people that fall in love with people like, I mean, how many Tesla investors fell in love with Tesla and Elon Musk? And like, man, when I was shorting Tesla, when it was at its all-time highs in 2021, people were like, oh, you're going to get wrecked. Oh my goodness. And it's like, dude, I've been long and short that stock 100 times since then and made money generally almost every time. But it's all about the time frame. Time frame is very, very important.
All right, so let's talk about managing risk, because let's say people do want to short Nvidia, not investment advice. I'm against shorting even Nvidia, and I've written plenty of articles about that and done posts about that, and yet inevitably people will say, "How's your short doing, Guy?" Again, you're not paying attention. But let's say somebody wants to take a bearish bet on Nvidia, because the generals, going back to the earlier conversation, will fall to the soldiers at some point. The problem with shorting a mania is that it can get more manic. And I think it's very clear. It's very clear we're probably in a blow-off top now, and we're in this potentially final phase of a mania, but that can be a couple months. It could be 50% higher from here, for all we know. Right? Stupid things get even stupider, right, when you're in these kind of environments. So, but you still want to take a bearish bet. So how do you manage the risk there? Because we know shorting at unlimited risk on the upside. Maybe you do puts, you're at least limiting it somewhat, but talk about that.
Yeah, so I think the key is, right, it's how much are you putting into that trade. So again, there are ways to leverage, and then there are ways to mitigate that by lowering that amount. And just one of the biggest things I learned, and I learned this the hard way, is when I go into a trade, I go in not expecting to win. I think that's the mentality most people enter an investment with. They're like, oh man, I can't wait till this goes up 100x and I make that type of money. I go in and I say, well, I might be wrong on this, so I'm just going to dip my toe in the water right here and test the waters and then just see how it behaves. I have these factors. I have this thesis on this trade. Let me just test the waters, because I've been wrong enough in my life where I know that that can happen, and I think that's important to recognize. So I think that's one way. Another way you could do it is you could do it with options, because you know your max loss is 100% of that options trade. The only thing with options, again, is that you have time as an issue there, where it can expire at a certain point in the future, or will. And I think that's very, very tricky as well. So my biggest thing is, I have no problem with people doing longs and shorts, but just manage your risk by going small. Like, there's nothing wrong. Like, when you try to make $1 million, you go broke. When you do it the right way and do small amounts, that's how you build real wealth. And that's how it worked for me in my career.
And I'm sure you've seen some of those posts on Twitter/X of people that are like, I'm going to make $1 million tomorrow by doing a put option on Nvidia. And then, oh my God, I just went broke.
Yeah.
And it's like, this is another sign to me of we have to be close to some inflection point. And again, I know I've been wrong in my timing on this, but I remember I was doing an interview with David Lim. This is like a year and a half ago, right? Towards the very end of 2022. And we were talking about how, I think it was his cousin, who's like a kid or something, was talking about Dogecoin and cryptocurrencies, and didn't know anything about it. He just wanted to gamble because he thought it was funny. And I said to him very clearly, I said, this bear market doesn't end until this stupid shit ends. Yeah. I mean, the clip is still there. I look a lot heavier in that clip, right? And then you had this huge move in 2023. That's fine. But again, I go back to, most stocks are still below 2021 levels. So it's a weird bull market, maybe even a bear market still for most stocks. When you see sentiment like that, and I know that is a constant, this sort of gambling mentality is always going to be there, no matter if it's a bull or bear market. But when you see this type of sentiment thinking, these kind of posts out there, does it make you even more bearish when you see that type of mentality? It's like, there's something off here.
Yeah, and I think that's part of the gambling mentality is when the gambling gets to the point of, I mean, if we look at 2021, right? When was the market in the topping phase is when GameStop, AMC, and all these others were running. And then we had the bear market in 2022. And now we've literally a week or two ago, we've seen the same stocks making moves again, where there's no fundamental factors behind why people are jumping in. They're going with the greater fool theory that, oh, it's going to run 300% and then I can just dump it to someone else later on. And we saw obviously those stocks came right back in a lot faster than they did in 2021 as well. So I think that, when you get to kind of the point where you say, wow, there's no logic anymore behind this and it becomes that insane. You're right. We're very, very close to something, and timing is the tough thing. But remember, Michael Burry, I mean, back in 07, everyone was laughing at him. He was early, right? And then what it ended up happening. And so timing is always a thing that I think you and we've always been a little early because we see things down the line. Like I think in trading like a chess player, right? 4, 5, 6, 10 steps ahead, which makes me say, oh my God, look at this coming down the pike. Let me prepare. But in reality, it does take time. Markets take time, just like the real estate market. I mean, we can see what's going on there, but it's slowly slowing and it will slowly start to go down over time. But yeah, it's going to take a while, but it is close. It is close. Oh, can't hear you.
I love this comment, a more serious comment. I work in a factory where basically a lower class income. I had the classic people that know nothing about investing ask me about stocks a few weeks ago. And I'll tell you anecdotally, because I talk to financial advisors, people think all I do is like randomly post on X. Like I have 35 meetings this week, right? I'm talking to advisors all day long. And I had several advisors even earlier today say they've got conservative clients of theirs that they're managing assets for saying, I want Nvidia. Yeah. It's like, you got to be close. I don't know when. I know you can't back test it. It's more of a feeling, and I'm much more on the quant rules-based side, but you just got to be close to something breaking. And by the way, it's interesting that all this is, and I want to get your thoughts on this too. It's interesting that all this is happening seasonality-wise as you're entering the worst 6 months. The sell may go away period, which doesn't mean stocks have to go down. Sell may go away just means stocks have lower average returns than November to April. But all this is kind of converging when, anyway, seasonality-wise, things are starting to potentially turn regardless.
Mm-hmm. No, yeah. I mean, it's the seasonality is a good point to bring up, but I think even more importantly is how does the Fed maneuver now, right? So we're at a point where the consumer is clearly starting to be stretched, and it's really the lower to middle income consumers that are invested in the stock market. We've seen McDonald's even say that, hey, we're losing people that can't afford to come to McDonald's because prices now are 3 times higher, whatever they are. But at a certain point, things will definitely unravel more and more. And the question is, where is inflation at that point? And can the Fed act aggressively? And the markets, I think that's part of the issue here is we have now been, as investors, so conditioned to just assume the Fed will bail us out every time. It's almost like the parent where they're right behind their little kid, and if the kid falls over, they catch up, right? They never let the kid fall down and be like, wow, that can happen. Let me learn from that and let me kind of figure out how not to fall down. No, we're going to catch you every time. And that's the mentality that you now have because the Federal Reserve has programmed the market in this way. And I think that, to be honest, is not, we've talked about what happened in 08, 09. Whenever this does collapse, it is going to be far worse than that. It really is.
Well, it almost has to be because every single round of stimulus creates more leverage, which creates more fragility, which creates a bigger drawdown.
That's right.
Because you never really flush the system long enough for the deleveraging to take place for things to actually be healthy to resume and start higher. I want you to talk for the final few minutes about verified investing, everything that you're doing, your service, your site. Like I said, I give you a lot of credit. I've had plenty of people on Spaces. I've interviewed over 600 people on my podcast. And I think a lot of people are smart, but they don't actually have skin in the game. I think you do. And I do believe that I do believe that you have the integrity. I do believe you have the integrity. I hope that doesn't come back to haunt me, as it has come with some other guests. But I think you're among the
I appreciate that.
No, I'm clear about that. So please, I want you to talk about that. Just kind of do a pitch on what you're doing.
Thank you so much. And listen, Verified Investing is the website that I've started with a bunch of traders and investors. And essentially what it is here is it's a compilation of everything I wish that I had as a trader or an investor, right? So not only do we have shows where literally I talk in the game plan every morning and give kind of my game plan, my thesis for the day, what's looking to move, what the levels are. But then as we scroll down, you have this area where these are like the latest kind of my version of tweets, where it's the kind of the insight data, what's important to the market. And then even below that, we have things like the verified pro charts, which are the verified pros posting up that are part of this. And by the way, we're continually bringing in new pros that want to participate in this. And my goal is to make it the website where people can come to for data-driven analysis. And by the way, data-driven doesn't mean it's going to always be right, but it's what are the probabilities favoring. And just to show you guys down here, we have economic charts, the earnings calendar is here, the economic calendar is here. So all of the data that you want, even down to the heat maps, as well as the fear and greed for crypto and stocks, and the Fed Watch tool updated daily, so that you have one place to go, or investors have one place to go. And of course we have services here, and we have lots of educational stuff, but when it all comes down to it, it's, you know, at this point in my career, I'm kind of winding down my career. What can I create that will last beyond me? And this is the website that I hope I will lure in the best of the best traders and investors, and they will come together to make something that investors can find real value in.
You can tell I do this totally on my own because I'm like clicking away after doing this. So I'm trying my best, folks. Everybody, please make sure you follow Gareth Soloway, and also follow me. Final thing I want to ask you, because I know you went through this. I think you had a time. I don't think you have it currently, but I think you went a time also on your Twitter X account where you went private on your post, which I did about myself last week. Help me out. At what point is that worth undoing? Because it kills the impressions, kills the clicks. For me, I just got tired of the insanity, and I have a very particular vision. In an ideal world, I get my credit event finally, and then I return to the public side on Twitter/X with just one tweet, melt up, because I will be as bullish as it gets, as everyone. It's like somebody said to me, "When's the last time you were bullish?" I said it was the last time everyone was bearish. I'm not a perma bear. I'm trying to read the tea leaves, and I have a contrarian take in general. But how did you figure out when to undo that? If assuming you don't have the private post on anymore.
So basically what I did was I just made it to verified accounts. They could. So like my thesis is that Twitter has become, or X as you call it, it has become a cesspool of bots / just the people that want to kind of the lower, like all the base level stuff. Like, and there's a lot of people out there that just want to take you down because they view you as being successful, whether that's, and they're not. And it's just the nature of it. And so there was a point where, I would just be like, you know what? At least make them verify their account so that they're not truly hiding behind some fake account and fake name that they have. And that was kind of my thing there. Now, in terms of just removing it, like it's the key is, can you get to a point where you just don't even read the comments anymore? And that's the sad part, because I know you and I both want to read, and we want to respond, and we want to help people that are asking good quality questions. But on X, it's kind of like, dude, it's not worth it anymore. It's just, and I hate to say that, but it's kind of gotten to that base level where it's either you don't read them at all and you leave the comments open, and then you get lots of interaction and they spread it around, or you do something like verified accounts or whatever, and then it does limit it. There's no doubt about it. But listen, man, it's the world we live in today. I've been a big believer that social media is probably one of the biggest downfalls of society. Not that it doesn't do certain things that are good, but when you have girls and boys feeling bad about themselves at the age of 13 because what they're seeing on social media, it's just garbage, man.
Amen to that. Everybody, please check out Verified Investing. Follow Gareth, follow me, and be respectful in the comments. It's not that hard. We're all right and we're all wrong. That's how this business works. Thank you, Gareth. I appreciate you.
Thank you so much. I appreciate you too, Michael. Thank you for having me.
And thank everybody for commenting and for watching live. I will have this edited and on my own stream, as I'm sure Gareth will as well, in a couple of days. Thanks, everybody.